Welcome, everyone. Welcome to this edition of Crashes and Taxes. I'm so glad you are with me. I just want to thank everybody for the amazing reception that we had for my last podcast, which really could have been, as everyone has told me, probably 3 podcasts for the amount of content and information that I was delivering. But, it was a big project, and I get projects done and I push them out, and then hopefully they will get enjoyed by the world, because the world definitely needs to understand, what's going on and where we are. So this will be a lot shorter of a podcast. Absolutely. It's going to be really fast compared to the last one, but we do have a lot of things that are going on that are quite alarming. So I'm going to go ahead and share my screen with you guys, and let's get started on what's going on. So I might take myself off here for a second. The first thing I want to remind you guys, as I've been showing you guys, that liquidity was going to be a big issue. In fact, liquidity will be the issue. And we are starting to see that in spades now. I went down this rabbit hole about 3 years ago. This month, actually, 3 years ago. I've always been in heavy analytics, but things started to change 3 years ago this month, and I haven't really gotten out of that analytical quagmire since then. So it's hard for me because I think that I see a lot of things coming, and obviously with my client base, we're certainly preparing for a lot of things coming, but it's hard to do a public podcast, hard to go on public interviews, which I do every week nationally, and discuss these things because they just lead to a very uncomfortable place, and it leads to very uncomfortable conversations, and it leads people to realize literally how vulnerable we all are since 2020 pandemic because of what it's being moved into. And so I'm going to have to do another podcast, not today. Today's much more economic in nature, but I'm going to do another podcast to really talk about how far this rabbit hole we're down and where we are. But I want to just point out, this was a something from the 3rd week of February about the stock market being under pressure because of 3 key sources of liquidity. So understand that, so let's go through what Bank of America says. Liquidity is drying up. So first of all, quantitative easing from the Fed is over. Not only are we not in QE, but we are in QT. QE is quantitative easing, where the Fed is actually printing money and stimulating the economy. Since 2008, 2009, modern monetary theory has taken over, and we have just pushed a ton of stimulus into the market. Well, if the market gets used to very cheap capital and a ton of stimulus and it grows gangbusters, what's going to happen when the exact opposite conditions are thrust onto the market? And that's what Bank of America is pointing out here. A little late, I would say. I've been talking about this for the last 12 months, but we're going from QE to QT up to $95 billion a month is being sucked out of the system in liquidity because the Fed is selling their balance sheet. They have over $8.4 trillion of balance sheet, which is completely unprecedented, only because of the global pandemic. So we don't have the QE anymore. We have moved to QT. That is a huge problem. We have no more fiscal policy, not monetary policy. We have no more fiscal policy like we had the PPP program, the Paycheck Protection Program for employers. We had all kinds of coronavirus funding and all kinds of things. All of that has also now, there may be some trails, but now mostly ended. And then, of course, because rates have been raised so much since 2022, we no longer have low cost of capital, making it a lot more expensive for companies to borrow. So any type of liquidity issues, this is America. This is the liquidity issues that we're experiencing. Today, we're going to talk really about emerging markets, but I do also want to bring up this Japan issue. Their bonds breached their cap. And so Bank of Japan stepped in with buying loans on another emergency basis, 3rd week of February. So again, a lot of indications, but this is really where we want to go now, which is this article talking about the riskiest markets of the world, going into crisis with liquidity drying up. So we're going to actually literally go to this article with basically Yahoo Finance, and we're gonna like literally go through it and like make you guys understand like what's happening. So this is the article. It's actually a Bloomberg article, but I picked it up in Yahoo because I'm on Bloomberg all day. So basically you can see this came out on March the 6th. And it's pretty serious. Hospitals are delaying surgeries in Sri Lanka. International flights to Nigeria have been suspended, and there are factories in Pakistan that are closing. These are the world's most vulnerable nations, and the situations on the ground are really dire. There are shortages of dollars that are crimping access to everything from raw materials to medicine. Governments are struggling with debt as they chase rescue packages from the IMF, the International Monetary Fund. So for those who were bullish on emerging markets, which a lot of the analysts this last 6 months were definitely moving to EM and thinking that this is where we could get some growth, even if the United States is faltering. That's just kind of ludicrous on its face, because if the United States is facing massive liquidity problems, then you're going to see that at the world level, at the IMF level, the World Bank level. It's absolutely going to be a problem across the board. So what I wanted to show you is, let's look at this quote here from a emerging market and frontier market strategist in Dubai. And basically they're saying the real crisis is brewing in these troubled nations. And for some time, things can get even worse. Investors will need to be more vigilant in screening for vulnerability and differentiating country risk to avoid being surprised by the next Ghana or Sri Lanka. And Pakistan factories have halted operations as they've run out of hard currency to import materials. In Sri Lanka, the government has set a limit of 20 liters of fuel per person a week, because government hospitals are postponing surgeries and they have a shortage of drugs and other medical supplies. And then we have international carriers that are suspending flights to Nigeria because they can't repatriate dollars from that nature. From Nigeria. Bangladesh, we've got basically people seeking $1 billion of foreign currency from the central bank to fuel imports to avert a looming energy crisis. And Malawi, too, is facing a shortage of pharmaceuticals, fertilizer, digital diesel. So we have a situation where the basically next generation's market index of JP Morgan Chase basically says that its pre-emerging countries have posted a 0.4% drop last night, which is the biggest drop since September. And against the dollar's strength. Remember, we're talking about the strength of the dollar because Powell keeps pushing the rates. Currencies from Ghana, Egypt, Pakistan, and Zambia have been basically crumbled more than their global peers. So what are we, in fact, stating? We really are saying that we are at a precipice of where things are. And as the rest of the emerging market. See, this is the problem, because we could have one particular thing coming from an emerging market and that economy collapses. Then the developed world can't get that specialized thing. Every country has its own specialized export, whatever, import, whatever. If we can't get it, that will then have a cascading effect to non-emergent markets, intermediary markets, and then certainly to all markets. And it's what we've been talking about for a long time. Liquidity is going to be the crisis. And if you just think about it from a logical perspective, if we had a lot of excess capital, stimulus, cheap rates since 2008, 2009 global financial crisis, and it has made a sustained recovery, a sustained level of market growth. I mean, over 15%, S&P 500, including total return, including dividends, for a 10-year period of time is insane. And it only happens in the outside of being organic, if we had some kind of new technology like AI and just took over the world, which that is yet to come. But outside of some kind of new technology and new like FANG stocks and moving to social media and all those things like we did from 2000 present day, you are going to have the exact opposite. You're going to have a situation where all of the draining of the liquidity that was just pushed too much too fast post coronavirus the drain is going to cause the exact opposite impact. It is only logical. It only stands to reason. If we had a massive 10-year run because post global financial crisis, because of stimulus and cheap cost of capital, when those things are reversed, we're going to get the exact opposite. It is just common sense. You can read all the articles in the world you want, but this is why I've been harping on liquidity. And even though Powell has no options and he's backed himself into a corner, the Fed has backed themselves into a corner, the IMF has backed themselves into a corner, the World Bank is, every global player that controls monetary supply has back themselves into a corner. Now, in order to prevent the currency from collapsing, they must keep the currency strong. But in the case of the dollar, all of these other countries, I talked about, Swiss National Bank losing $143 billion in 2022 because of the exchange rate. And that has not happened in their 116-year history. So we need to understand that where we are is an unprecedented situation. It is a global confluence of economic events that are unprecedented to this level and this extent. And what that means is we are going to get an unprecedented outcome, unfortunately, on the negative side. And what's happening as these countries continue to fight against the strength of the dollar, and Egypt in particular, I'm thinking of, they're just going to simply move to an alternative way of transacting business. And I need to do a deep dive into India, because their currency has really springboarded, if you will, into a new potential global player that some 80 countries are looking and thinking about, denominating in, which is really interesting. So the BRICS nations, again, as I've said, the Shanghai Development Corporation, the BRICS nations, the Belt and Road, the infrastructure, all of these things they've been working towards is really where we're at. Now, this is concerning from a U.S. perspective because China aligning with Russia, which they've been aligned for 20 years, that's not a surprise, but them aligning with Russia potentially in a war effort with Ukraine is a problem. And I've read, unfortunately, a lot of deep analysis that shows that America would lose. I mean, we would just lose to fight China and Russia, both nuclear powers, on a united front. We need to be realistic about what the prospects are for the United States. So here's a Bloomberg article. This just is out March 5th. Holding cash will be a winning strategy in 2023, according to investors. So again, if liquidity and the dollar is super strong, holding onto your cash. A lot of people are calling the practice and wanting to talk about, treasuries and all of these things. And normally a high treasury on a short-term basis, especially with an inverted yield curve where we can get bigger bang for our buck on even the 2 and 3 year over the 10-year, certainly would be very attractive. Usually it's the opposite, where the 10-year gives you more because your capital's locked in for longer. Certainly attractive, except in this rare and very unusual case of a currency change. And that's exactly what we actually are in. The dollar is in the process of being delegitimized as the sole reserve currency. Dollar hegemony is going away, and we are moving to a multipolarity world. This is happening. I don't care who says it's not. I don't care what article is written that it's not. There's 1,000 articles written that it is. There's 1,000 pieces of analysis that have been done that it is happening. It is happening. And that means that, the regular short-term safety nets that we might take, like treasuries, like a substantial amount of cash, we would instead look to what I call a bridge asset, where we're going to bridge over and jump over this sort of situation. I want to just point this out. I definitely point this out to my practice, but I just wanted to let you guys know that we did have the World Gold Council come back in February at the beginning and restate last year. They had originally said it was the largest gold buy by central banks since 1967. In 2022, that was reported. They came back and said, no, we're sorry, we were wrong. This is the largest gold buy by central banks of the world ever recorded. So that is telling us something when we're looking at bridge assets. And of course, we know that Basel II, or Basel II, as they pronounce it over in Switzerland, Basel III rather, moved gold from tier 3 to tier 1 for central banks, meaning they can count it dollar for dollar, not have any discounts on it. And of course, we already know, this came out third week of February, that Russia has suspended its final remaining nuclear treaty with the United States, opening the door to what Putin says could be, a nuclear ambition on the part of Russia, tactical nukes. And I just want to, really kind of end by just reminding you guys that, big money is not in the buying and selling, but in the waiting. We are in a very distinctive period of time. And if you think that you're going to go to your advisor and say, let me chase yield in this sector, this sector, or this sector, you can do that all day long. I'm telling you, this is a bridge asset year. This is a transition year, more so than even 2022. And if you aren't in bridge assets, you are going to be sorry. That is my professional opinion. And I'll just end to remind you guys to definitely go and check out this last podcast that I did, Unraveling the Web of Globalization and Totalitarian Control of Humanity, because I think when you start to understand what the governments of the world have prepared their citizens for, the amount of control and power that they have over those citizens, then you will more fully appreciate the information that is being relayed to you guys on this podcast on a weekly basis. So please basically go out and share this podcast. Get your friends and family to understand what's going on, because between the liquidity crisis that's definitely heating up and where we're headed the rest of this year, we have a lot of challenges ahead of us, and we can get through them with honesty and transparency. And a lot of that is lacking from both the central banks of the world and the governments of the world. So, and then of course, right now we have the WHO, and that's a whole nother podcast, but we have the WHO that's actively trying to get 196 countries to pass amendments that will end national sovereignty. And I don't care what article you read that says that the Senate has to approve it. It's not true. It's not a treaty. It is an agreement. It's not a treaty. It does not have to be approved by the Senate. So that means that Biden and his administration, the amendments that they have promulgated, that they wrote, I need you to understand, the Biden administration wrote a substantial amount of these amendments for the WHO pandemic agreement. And it's alarming, and that's a separate podcast. So we have to stay vigilant on what's happening now. I hope you guys are having a great ending of the winter, beginning of spring. I can't wait. I'm ready for the spring. Hope you guys are doing great, and we'll talk again next week. Take care, everybody.